Hey everyone, welcome back to your weekly market outlook. This is for the 8th of July 2024. Let's just jump in very quickly into what's going on last week. I want to focus a lot more on the US economic data here. So we have the ISM manufacturing PMI. We saw a drop in the manufacturing PMI here. Expectation was for a little bit of an increase in manufacturing PMI. We actually got a drop from 48.7 to 48.5. Services PMI, huge drop, 53.8 to 48.8. And then we have the FOMC meeting minutes as well. And then we do have comments coming up from Chair Powell in terms of, what's the current condition in terms of the labor market there, and also in terms of the debt that the US has been accumulating. It's not looking that great, because if we take a look at the number of debts right now in the US versus kind of more of a full employment condition in the US, it's just not a great future at this point in time. So we do have that little bit of a dovish comments. We do have that manufacturing PMI, services PMI below market expectation. And then we have the NFP numbers and the unemployment rate. So this one here is a little bit of a mixed data. So let's take a look at the NFP numbers first. The NFP number, we had 206. This is higher than consensus of 190,000, but we do have a downward revision from 272,000 to 218,000 for the month of May. So that's really not that great, considering how the situation is under downward revision. So a little bit of a surplus. This is above 200,000, but the huge shock for the market is the unemployment rate. Now, unemployment rate is expected to remain stable at 4%. We got 4.1%. Now, we have mentioned this previously in the previous months that, if unemployment continues to go up, it's not going to be great for the U.S. labor market, and this kind of prompts the FOMC to potentially lower interest rate as quickly as possible. Right now, we do have that shift coming in right now. Market is expecting September to be the potential first cut from the FOMC now, but just looking at this data here, I think it is very supportive of that view there in terms of whether or not inflation is going to factor in. That's something that we need to discuss for this week's number. Now, before that, we do have testimony and for Powell. That's going to be on Tuesday and Wednesday. This is semi-annual testimony given to the government. Obviously, this is going to have a little bit more of an impact. Questions about potential rate cuts, we're probably going to get some of the hints there. But again, if we take a look at the inflation number here, headline inflation is expected to drop from 3.3% back down to 3.1%. Core inflation expected to remain stable at 3.4%. In terms of inflationary growth there, we're expecting the monthly growth to go up a little bit from 0% to 0.1%, but the core remains flat at 0.2% growth. So, judging by this, if we take a look at the potential for that inflation outcome to kind of cool down a little bit, there could be a huge potential in the market pricing in for that rate cut to happen. Obviously, this is going to pressure the US yields, and then in turn, that's going to drop the US dollar down a little bit. So we'll take a look at that on a technical perspective. But consider this: if the inflation rate comes in as per consensus at 3.1%, we might see the US dollar weaken, because then the rate cut is probably going to be factoring a lot more. If we have a number that's below 3%, that's going to be a very huge push to the downside for the US dollar, because then everyone's just going to be expecting, okay, labor market is not doing that great, inflation is already cooling off, so what's the FOMC waiting for? So we could expect probably an earlier rate cut coming in from the FOMC. But for now, September is going to be the rate cut that's expected. But yeah, that's already moving down ahead of the schedule by about a month or two for the FOMC. All right. Let's focus on the Aussie USD. So we finally broken out of the range here, 66, 67. We can say goodbye to that. We have surpassed 67. We're still below 68. But right now, if there's any correction that could happen in the Aussie USD, we're looking at 67 cents to be that well supported level for the Aussie USD. But this one here has broken out of the range. We are expecting this to continue to the uptrend for now, and especially in with the expectation that US dollar could actually weaken because the FOMC will probably start cutting interest rates soon in the month of September. That's in line with the view that we have here for the Aussie USD. And one of the other driving factors for the Aussie USD is obviously the hawkish RBA and the inflation heating up again in Australia. So instead of a rate cut that could happen in 2024, market is already factoring in the potential for the RBA to actually hike interest rate one more time in 2024. Next is the Euro USD. So we got the elections done from France at this point in time. Position wise, from a technical perspective, we talk about a potential bounce of that order block there, close to 1.0650. We saw that bounce happen. Price breaks above 1.08, so that was a level that was tested last week as a potential resistance, and then once price broken out of it, it becomes a support. Now this is going to be a support that has been tested on Monday Open. Monday Open, we actually gapped down close to 1.08, and price has just bounced off 1.08 level. This is currently trading above the Ichimoku cloud right now in terms of projections on how far the Euro USD could go. We are currently projecting a move towards 1.0850 and 1.09 in the near future, for as long as price is traded above 1.08. Things would change if price is traded below 1.08 this week, but for now, we're looking at the bounce that happened on Monday morning. We saw the market gap down. It was well supported at 1.08. We saw buyers coming into the market early Asian session. We saw this lift away from 1.08. So immediate resistance would be 1.0850 up to 1.09 in terms of where the Euro USD could go. Now, if we take a look at the weekly pivot, the R1 is close to the 1.09 at 1.088. All right, next is the Pound USD. Very similar situation here. With the Pound USD, we always mention that in terms of whether or not buyers going to come in at 1.27, we don't see that to happen. We expect a lower buy-in at 1.26. We saw that happen in the past 2 weeks. We saw that increase in the sterling here. Obviously, the election does help in terms of the change from the Conservative to the Labour government at this point in time. So this is the 14 years in terms of how long the Conservative has ruled in the UK. But things are about to change. People are looking for that change. People are looking forward towards a change that boosted the sterling. Right now, we got one more key level to go, right? That's 1.2850, and this is going to be the key level that needs to be taken out this week. Once price has broken above 1.2850, then we anticipate further gain on the sterling here. How far can it go? We're looking at a range between 1.2925, 1.2950 as a potential move for the sterling this week, especially if the CPI in the US cools off. Okay, right. Last one, we have the dollar Japanese yen. Now with the dollar Japanese yen, obviously this is already heating up a lot, right? We were looking at resistances, we were looking at potential profit taking. There was no intervention. Now this is crucial. This is a crucial point to take. With the weaker fundamentals last week, with the 4th of July holiday where there's not a lot of liquidity in the market, the government, the Japanese government didn't step in to intervene. Therefore, at this point in time, it is actually very safe to assume that they're not going to be stepping in, at least not around this level. The potential for them to step in, which they would have to step in, otherwise it's going to look bad for them, it would be about 165. So we're not really concerned about any intervention at this point in time. We're looking at a pure technical correction that's going on right now. We do see the dollar Japanese yen soften a little bit, but the euro yen and sterling yen was pretty much really strong. Turn of the week, Monday morning, we saw the euro yen and sterling yen weaken a little bit. So this is pretty much following what's the dollar yen doing right now. In terms of correction, take a look at 160. 160 is where the support one is located. 160 was the level where the Japanese government intervened previously, end of April. So we are looking at 160 as the immediate support level. That's also where the 23.6% is currently located. we do prefer a deeper correction. We much prefer a correction that hits 38.2 or 50%. Again, that range is going to be 158 and 159. We much prefer that level of correction for the dollar Japanese yen, for it to has enough room for it to actually be more interesting to buy. But very happy to see 160. If price bounces off 160, we could potentially see more carry traders come back into the market there. But yeah, these are going to be the three levels: 158, 159, 160. We are looking at the buy on the dip scenario. We're not in the mood to buy Japanese yen at this point in time. So yeah, if we take a look at the dollar Japanese, and we still much prefer to short the dollar Japanese, and therefore we prefer a buy on the dip scenario. If price manages to pull back down, we're looking at the limit at around 158 to be really attractive. Can it go even lower than 158? It could, but going any lower than 158 could take away a lot of the momentum there for the dollar Japanese. And so yeah, we much prefer to see price bounces off 158, 159 or 160, right? If we see a lot of demands at 160 and price is able to maintain the position back up above 161, then I think we could see that push towards 165. Again, these are the three levels where the dollar Japanese yen could bounce. We prefer a lower level, but again, we'll see what the sentiment is in the market. But judging by what the expectation is for the CPI, and if the CPI does cool down significantly, then yeah, we do anticipate a much deeper correction for the dollar Japanese yen. All right, so that's pretty much it for this week. Good luck to your trades, and I will see you soon.